virtual stage to Hugh Montag, research economist at the Bureau of Labor Statistics, who will be today's moderator. Hugh?
Thank you. The topics of today's sessions are dynamic pricing under information frictions, evidence from firm-level subjective expectations, and the causal effects of tariff uncertainty on consumers' macroeconomic expectations and spending plans. I'd like to give a special thanks to the organizers, Raphael Schunde and Dominic Smith. This webinar is 45 minutes and will consist of 2 presentations of approximately 15 minutes each and 10 to 15 minutes for questions and answers at the end. Attendees do not have the option to switch on their audio-video, but are invited to write comments or questions in the Q&A space. Attendees can post their questions during the presentations, and they do not have to wait until the end. I will then select questions to be answered in the Q&A portion of the webinar after the presentations. This webinar is also being live streamed right now via the CBRA YouTube channel and is recorded to be made available on the CBRA website, www.cbra.org, and the CBRA YouTube channel after the event. Links to the papers will be available in the YouTube video descriptions if provided by the authors. Finally, a disclaimer. Participation in a CBRA webinar does not constitute or imply an endorsement, recommendation, or favoring endorsement of the views, opinions, products, or services of the Central Bank Research Association or any other participating institution, individual, or entity. All views expressed during a CBRA or CBRA-hosted event are strictly those of the authors, discussants, and other participants, and not those of CBRA, the co-sponsoring institutions, or any other participating institutions. Okay, without further ado, first is Luca Gagliardone, postdoctoral fellow at Yale University, presenting dynamic pricing under information frictions, evidence from firm-level subjective expectations.
Thanks for having me. I'll share the screen. Can you see the slide? Yeah.
Yes.
Okay, so this is joint work with Joris. Joris is at the Bank of Belgium, so the usual disclaimer applies. Thanks for having me. I'm happy to be here. So the question that we ask in this paper is how forward-looking are firms? In practice, we are interested in quantifying, estimate how much a change in future cost that happens in the upcoming months and is anticipated is passed into current prices. So a dynamic pass-through from cost into prices. And this is, of course, a central question for many applications. For example, if you're interested in forward guidance, this is a key object that you would like to know, but also for non-monetary questions, such as the pass-through of anticipated shock like tariffs. And so I will argue today that one of the answering this question eventually boils down also to the estimation of the discount factor of firms. In the discount factor the firms are using to compute the expected discounted present value of their marginal cost when they're setting prices. And this is an object that is typically quite hard to estimate, especially with aggregate data in which the usual concerns apply. So instruments for expectations are hard to find. They're typically not powerful. The measure itself of the correct measure of expectation to use is not often clear. Is it expectation of households? Is it expectation of firms? How do we aggregate them up? And then in general equilibrium, there are all sorts of endogeneity concerns that are typically hard to tackle. Microdata allows typically to resolve many of these concerns. Finding instruments that are powerful, it's a little bit easier. We have a clear notion of which expectation we should use, and also we can control for general equilibrium feedbacks with time fixed effects. But in the paper, we argue that there is an extra advantage of using microdata, which is really that you can disentangle different sources of price inertia that are behind the correlation, the intertemporal correlation between cost and prices. And in particular, we focus on kind of 3 main type of frictions: nominal, so Calvo versus Menu-Cost model or Menu-Cost model; real frictions, which we intend the real friction with the strategic complementarities in pricing, the movement in markups. And importantly for this presentation, we're going to talk extensively about information frictions. So more in detail, what do we do in this paper? We start from a New Keynesian framework with strategic complementarities. This extends my earlier work with Mark, Simon, and Joris, to allow for private information that firms have about cost, about the evolution of their own cost. The model delivers in a reduced form representation, a reduced form pass-through regression at the firm level with the behavioral wedges. And here is the intuition is that even if in the model firms are fully rational and they use information optimally, incomplete information distorts their pricing behavior to appear as if they were myopic, anchoring current prices to past prices and underreacting to cost shocks. Now, the model can be aggregated nicely, delivers a Phillips curve at the aggregate level in closed form, which is hybrid in the style of Galli-Gertler 99. And in particular, it features a high aggregate level of discounting, which follows from the estimated micro level of myopia, and then a rich dynamics with a ham-shaped impulse response and a potential role for long and variable lags. To quantify the model, we have a novel data set at the micro level for the Belgian manufacturing sector, monthly frequency between 1995 and 2023. What we observe is total variable cost at the firm level, product level prices, physical quantities produced by the firm, and this is merged with a survey that has been run internally by the Bank of Belgium that elicits subjective expectations of firms regarding the evolution of their own prices in the upcoming months. Now, without further ado, this is going to be a structural paper, so let me guide you a little bit at a high level through the model. So there is a heterogeneous firm that chooses log prices, reset prices a la Calvo, so they maximize the expected discounted stream of profits subject to a nominal rigidity a la Calvo. And they also face a downward sloping demand curve with Kimball preferences. So this is a simple way of embedding into the model strategic complementarities. In the paper, we talk about other forms of demand, oligopoly, and so on and so forth, but up to a first order approximation, these will be equivalent ways of attacking the problem. Production function for today's presentation, I'm going to assume that there are constant returns to scale. In the paper, we relax it. What constant return to scale buys is that we can assume that marginal cost follows an exogenous process. And in particular, we restrict the attention to an AR1 process with Gaussian noise, where rho here is the persistence of this marginal cost process. And then on top of this, there's going to be incomplete information. Firms face a systematic measurement error of marginal cost. This is nominal marginal cost, so perhaps they observe with error the aggregate price level, or it's not easy for them to estimate precisely the production function and therefore the marginal cost. But bottom line is that what firms observe is a private signal regarding marginal cost that is noisy. So it contains some Gaussian noise. And the Gaussian noise is orthogonal to the fundamental innovation, so it is optimal for firms to forecast everything using a Kalman filter. Now, let me guide you briefly to some notation, because then I will estimate these parameters. So the problem of the firm is to maximize the present discounted value of profits, where expectations are subjective. So you see that expectations have a subscript that is IT. The first order condition of the problem after log linearization reads in a very standard way. So the price that the firm would like to set condition on adjusting is the present discounted value of a markup over marginal cost. Then because of the log linearization, the markup depends inversely on relative prices. So I plug the log linearized markup, I solve for it, and it turns out that the reset price is the present discounted value of a linear combination, the square bracket, of the marginal cost of a firm and the price index of competitor. Okay, here it will simply be the aggregate price index, but it is easy to relax. The linear combination has weights omega. This is one of the parameters that we estimate, which is the degree of strategic complementarities. It is a one-to-one mapping with the curvature of the markup. And then the discounting has inside the Hausdorff discount factor beta as well as theta, which is the Calvo parameter. So this is the pricing equation at the firm level with subjective expectations. Then how do firms form belief? Optimally using the Kalman filter. And this is a simple updating formula using Bayes' rule, in which the expectation that the firm has on the marginal cost is an AR1 process, so it depends on the expectation it had last period. Lambda is the persistence of belief, And then new information fits into expectation with a Kalman gain coefficient that depends on the persistence of the belief process relative to the persistence of the cost process. Okay, so it takes a little bit of work to show how the model can be represented in a reduced form, but it leads to a dynamic pass-through regression, which I will now explain. So the key idea for moving from this model that I just show you into an equation, a moment condition, and can be implemented in the data, is that the model under incomplete information is observationally equivalent to an alternative economy in which information is complete, but preferences are distorted. So now we are introducing some behavioral wedges, which are these parameters in red, that embed the role of incomplete information and allow to map the model to the data. Then we can bring this equation to the data, estimate the parameters, and then from the estimate of these behavioral wedges, we can invert the model and recover the structural parameters of the original economy under incomplete information. So this is the logic. Now, let me guide you through this dynamic pass-through regression, what it means and what's the intuition. So on the left-hand side, we have the expectation under common knowledge. This is complete information. There is no I subscript of the growth rate of relative prices. Relative because I'm putting time fixed effects everywhere. So on the right-hand side, we have basically three terms. One is this square bracket, which is the long-run co-integrating relationship between cost and prices. If there was no nominal rigidities, how do prices are set? You put this square bracket equal to 0. And so you see that prices commove with marginal cost with a coefficient equal to 1 minus omega. And then there is an extra dampening, which is given by omega p, which under complete information, it will be exactly 1. Under incomplete information is a number larger than 1 that further dampens the pass-through from cost into prices in the long run. In the short run, however, there are nominal rigidities. And so when there is a shock to cost, the square bracket becomes positive. And that puts upward pressure into relative prices with a coefficient that is the slope of the Phillips curve. This is what this coefficient is. And then there are two more terms. One is the continuation value. This comes from the fact that the price setting problem is forward-looking. Under complete information, omega f, the behavioral wedge, is exactly equal to beta, the discount factor of the household. Under incomplete information, it's smaller than beta, and this is what I refer to as myopia. The last term is the anchoring term. There is a lag growth rate of prices. Under complete information, this is equal to 0. Under incomplete information, this is larger than 0, so there is extra persistence in prices. Now, you see here that there are 1 theta, 2 omega parameters, and then 3 behavioral wedges. So there are 5 parameters for 1, 2, 3, 4 regressors. So the model, if it is estimated without imposing any more structure, is under-identified. But fortunately, the 3 behavioral wedges have an over-identifying restriction. So there are 3 parameters in 3 structural parameters that are theta, lambda, the persistence of the belief process, and rho, the persistence of cost. So we can estimate this equation with GMM, imposing this moment restriction, instrumenting with lags of observables and expectations. This is all variables that are in the information set of the firm, and then recover the reduced form parameters, invert the model, and obtain the structural parameters that are behind the reduced form. Okay, so this is the strategy. Let me go to data. Empirical evidence. So the data sets that we have, I was saying monthly microdata for the Belgian manufacturing sector. We observe at the product level sales and quantity, physical quantity sold. So we construct prices as unit values. For cost, we observe total variable cost, which for us is wage bill plus intermediates, materials, and services. And then we have this survey that is matched with all the other data. In the survey, it's a directional service. They ask whether firms expect to increase, decrease, or do not change their own product prices in the upcoming month. So this is the information that we have. We're going to use this as instruments to the moment equation. And these are the results. So let's focus on the first column. So here, the top panel shows the estimates of the reduced form parameters, the behavioral wedges, and the bottom panel, the implied estimates of the structural parameters. So omega F was the myopia parameter. You see that the number is 0.82, much smaller than the 0.99 that one will calibrate it to in a complete information model. Omega L is the anchoring parameter. So this is approximately 10%. This is not very large. So this is relatively surprising. So this seems to suggest that at the micro level, the persistence of the model already captures all the endogenous persistence prices. And the underreaction parameter, this has to be under incomplete information a number larger than 1. It is, but standard error is a little bit large. So bottom
There's
line,
one or two more minutes left.
Yeah, so a lot of myopia, not much underreaction and anchoring. The implied parameters are theta 0.82. This is 1 year of stickiness. Omega 0.5. This is half of the pass-through of cost into prices absorbed into markups. And then lambda, moderate persistence of beliefs over time, and the high persistence of marginal cost. Now, let's go into the aggregate implications. So the model delivers in closed form a Phillips curve that is hybrid. In particular, it has inflation on the left-hand side on marginal cost, the slope of the Phillips curve. And then there is the forward-looking typical component of the Phillips curve, where the beta coefficient is here replaced by an aggregated discounting. And then there are extra terms. So there are 2 lags of inflation and 1 lag of marginal cost. These, we don't need to estimate these. Our micro estimates directly imply through the mapping with the structural parameters, this coefficient, these behavioral wedges. And so these are the estimates that are implied from our microanalysis. There is a lot of discounting at the aggregate level, much more persistence at the aggregate level compared to the micro one, and a moderate level of second order persistence and moving average component. So there is high discounting at the aggregate level and a lot of persistence in inflation, consistently with the Gallagher reward. Now, to conclude, let me show you what we can do with this model. So we constructed the aggregate level, an aggregate measure of marginal cost. We aggregate firm level data to have an index of marginal cost at the aggregate level. And then we feed that into the model to obtain the model-based inflation series. Okay, and here in this graph, I'm plotting what the model predicts as a function of the fitted series of marginal cost against the data. And you see that the model tracks the data quite well, both in terms of amplitude and cyclicality. In particular, the model that I show you today is the one in green, in which the slope of the Phillips curve is constant. The model in red is one in which I'm allowing time variation in the frequency of price changes, like a menu cost style type of model. But model do very well. The one with the time varying frequency does better in the recent inflation surge, which we know it was a big role. If you regress the model on data, you obtain an R-square of 0.73, and the beta correlation of the OLS is basically 1. So let me conclude. The core of this paper is to propose a new framework for identification. It is a dynamic pass-through regression and can be identified from data on cost, prices, and expectation. At the firm level, we obtain a high level of myopia and somewhat less degree of anchoring and reaction. At the aggregate level, the myopia implies a high discounting, and it can explain the hump shape and long variable lags of inflation. Variation in cost accounts for a large fraction of the volatility of inflation, at least 2/3. And then this has important implication for monetary policy and in particular forward guidance. Thank you.
Okay, thank you. Next, we have Damian Pfeiffer, Vice President in the Research Department at the Federal Reserve Bank of Cleveland, presenting the causal effects of tariff uncertainty on consumers' macroeconomic expectations and their spending plans.
Thank you, Hugh. I'll present the joint work with Bernardo Candia and James Mitchell. As we all work at the Cleveland Fed, that the standard disclaimer applies as well. So these are our views and not the views of the Federal Reserve Bank of Cleveland or the Federal Reserve System. So what do we do in this paper? There is, as you all are aware, there's been a lot of news about tariffs in the past year. So US tariffs rose from about 2% in January 2025 to about 17% in January 2026. And even after that, there was a SCOTUS decision that made them illegal. So basically, the tariff level decreased, although the administration again said that they will increase them with different tariffs in the future. So there's been a lot of tariff policy uncertainty in the news. And we try to implement a survey, try to see how all this news about tariffs actually affect tariff expectations of households and potentially their macroeconomic expectations and consequently their spending decisions. So even in the theory, we know that these relationships are to some degree ambiguous. There's been new tariff rates, come with a lot of uncertainty about the scope, about the timing, about the implementation of these tariffs, and about the retaliation. And so it's in our models. Depending on this, how we will model these issues, then it will depend what the final outcome of the tariffs will be. So in this paper, we then study how consumers actually perceive tariffs, how they change their macroeconomic expectations in the face of a tariff shock and their spending decisions. So very quickly, what do? We design a population representative survey that adds several questions about tariffs, about the economy, about expectations, about spending plans. And then we ask them a lot different hypothetical questions about the effect of tariffs on the economy and consumer spending plans. But then we also design a randomized controlled trial to test whether information treatment affect beliefs about tariff expectations and whether those tariff expectations have the influence on, as I said, the consumer's macroeconomic expectations, in particular their inflation expectations, their GDP growth expectations, and their unemployment rate expectations. And then we see the effects on the spending plans. And crucially, what we can do in this framework is that we can distinguish between the first versus second moment effect. If you just rely on the macroeconomic data, then it's very difficult to distinguish between the first and the second moment effect. But here we can design treatments about tariff expectation treatment that will be designed to influence either the first or the second moment effect. And we see whether potentially tariff uncertainty and the tariff level have different impacts on both macroeconomic expectations and the spending plans. Okay, so just a very quick preview of main results. The consumers do not interpret tariffs as a pure demand or a pure supply shock. We find that when we causally change that when we provide information about tariffs, this changes their tariff expectations. On average, consumers start with the belief that tariffs are about 30%. Our treatments would suggest that these expectations are lowered a little bit. But what we see is a very high pass-through between tariff expectations and inflation expectations, for example. A 1 percentage point increase in the level of tariff expectations actually increases inflation expectations by about 90 basis points. And very similarly, also tariff uncertainty has a very strong effect on inflation uncertainty. And then we will actually see that tariff uncertainty has a different effect on spending plans than higher tariff levels. In particular, the tariff uncertainty, triggers the precautionary savings motive, and they discourage consumers from buying durables, especially cars and big-ticket items. But tariff level uncertainty actually invokes the intertemporal substitution effect, where we want to preemptively buy things that we will think that the prices of those things will increase. And we actually saw quite a bit of evidence of that, especially in March and April of last year, when people were running into car dealership to buy new cars because they thought that the car prices will increase substantially. Okay, so let me tell you very quickly about the survey. I know that we don't have too much time. So it's a Cleveland-Fed's daily online survey of consumer expectations. We ran a special survey between October 29th and December 31st, which focused on tariff-related questions. The sample size is quite large. It's 12,000 respondents. And the RTC design is very standard. We first elicit prior expectations, then we provide information treatment, and then we elicit posterior expectations for all these variables and try to see the effect on that. So we have a control group, and we have 4 treatment groups. And in the first treatment group, we provide them information about the current tariff level, which were about 18% at the time. The second treatment focuses on tariff uncertainty, where we provide them the tariffs range between 10 and 100%. And as we saw, tariffs at the time on some goods were 10%, but on some other goods, they were up to 100%. The third treatment, we provide them some information that's the share of imports, for example, in the CPI, it's about 9%. And in the fourth treatment, we just give them an extreme scenario, again, trying to evoke uncertainty about tariffs. And we give them that tariffs are 100% on some goods, for example, on pharmaceuticals. Then we actually do a very similar Bayesian updating rule as Luca was presenting in the first paper. We just assume that G is sort of a Kalman game as in his system, in his presentation, and we assume that posterior expectations are a weighted average between prior expectations and the signal that they receive. And we just estimate, the standard treatment effects that are pretty standard in the literature. We regressed on the dummy variables for treatment, which give us the level effect, and then the slope effect, which gives us this beta J, which captures how informative the treatment J is. And in particular, if this value is significantly negative, then this means that consumers rely on the signal that we give them in our information treatments. And as we see, in fact, if we focus on the column 1, we see that actually a lot of our consumers rely on the information that we give them, and we are able to move their expectations. So basically, households consistently revise their beliefs towards the information that we receive. As we can see, for the implied mean expectations, we see that all these values are significantly negative. That means that our information treatment provides that households basically consistently revise their beliefs towards the information that they receive. But also importantly, if we look at the uncertainty about their posterior beliefs, we also see that the second treatment and the fourth treatment, which were designed to affect tariff uncertainty, actually also have a pretty large effect on posterior tariff uncertainty that households report. Let's first very quickly look at hypothetical questions about the effects. Now that we established that we can affect their beliefs about tariffs, before we go on the causal effects on the macroeconomic expectations, I will just very briefly show you that even with hypothetical questions that we designed at the beginning, we see that consumers revise their inflation expectations in the face of a tariff shock. And we designed hypothetical questions to elicit that. And we see that most consumers, 92% of consumers, actually think that tariffs will raise consumer prices. There is a little bit more dispersion of how they think about how tariffs would affect GDP growth and unemployment rate. But majority of the people, they see that the tariffs will both increase the GDP growth and increase the unemployment rate, which is definitely, violating the traditional Occam's law, how we think. So the consumers think that tariffs effects are potentially a combination of the different shocks, not just a supply type shocks, but also potentially they're coupled with a productivity shock. And this could potentially explain, this is one possible explanation for what we are seeing in our survey. And of course, there are quite a bit of differences across Republicans or self-identified Republicans and self-identified Democrats, where Republicans are, let me put it this way, a little bit more optimistic what tariffs will bring to the economy than Democrats. So then afterwards, we look at causal effects on macroeconomic expectations. And again, we are using the RCT information treatments as instruments in this equation that you see here. I don't have time to go into details, but basically we're trying to elicit the causal effect of information treatments. So when we change the tariff expectations of individuals, and we would like to see what kind of effect does this have on other macroeconomic expectations. And let's first focus on inflation expectations, and we see that 1 percentage point increase, if we focus on column 1 percentage point increase in tariff expectations would raise inflation expectations by 0.9 of a percentage points, which is a huge, it's relatively large reaction of households to a 1 percentage point increase in tariff rate expectations. Similarly, we also see that if we look at focus on this number here, we see that tariff uncertainty also increases inflation uncertainty, and in particular, it raises inflation. 1% increase in the tariff uncertainty raises inflation uncertainty by 0.8%. The effect on other macroeconomic expectations are a little bit smaller, but still very robust effect on these expectations. And all these effects are positive, as we saw already from our hypothetical questions that I briefly showed you. So now that we sort of established that it affects macroeconomic expectations, and we saw from previous literature that macroeconomic expectations affect consumers' decisions and outcomes, we also try to see how this change in tariff expectations would affect consumer spending plans. And there is a little bit of, the literature have different findings about the effect of inflation expectations on durable spending. For example, some literature show that this invokes a precautionary savings motive and decreases spending plans, but some other literature also find that this effect is positive, and that basically induces the intertemporal substitution effect. And here I'll have to mention the work by my co-author, Bernardo. His job market paper actually shows that this relationship depends on the level of inflation. So we also study in our framework, how tariff uncertainty and changing tariff levels would affect consumer spending. And again, we start with hypothetical questions, and we see that hypothetical answers are both consistent with precautionary savings motive and with intertemporal substitution effect, because they both say that they're more likely to increase wait and see, and that they're more likely to preemptively buy things. So we resort again to our RCT in order to provide us instruments so that we can use instrumental variables in order to determine the effect from both tariff uncertainty and the expected level of tariffs on the plans for durable spending. And we actually, as I mentioned you before, we actually showed that the effects are different. So if we increase the level of tariffs, then the effect will be positive on all these different spending plans that we elicit in this survey. Therefore, it means that it would invoke the intertemporal substitution effect, and you will preemptively buy goods. But if we increase the level of uncertainty, the uncertainty about tariffs, there is very significant effect that is negative, and that means that households are less likely to buy goods, therefore invoking these precautionary savings models. And I know that I'm out of time, so I will just leave you these slides for the conclusion, so we can go to the question part. Thank you.
Okay, thank you. Again, a reminder, if you have any questions, you can post them in the Q&A and I will field them. First question for Luca. What is it that we don't know about the firms in the data, but you think would be useful to add to a survey? And I guess this combines with the question I had, which is that it seems like the firm's subjective expectations were qualitative instead of quantitative. So I'm curious how difficult that was.
So that's one that limits the. So basically, in that case, you can use it as a shifter, but in principle, you would like to just plug it into the regression. So I had to figure it out a way to get around that. So having a quantitative answer to the answer would be useful. So we don't know much stuff about expectations. I remember in one of the previous editions in Frankfurt of the Inflation Driven Dynamics, there was Isabel Schnabel that said, we don't know whose expectations matter for inflation dynamics. I think we still don't know that. We perhaps know that it is firms, but then there is a network and how information spreads within the network that's largely unclear. Like if there is firms that matter more for like forming narratives and stories and coordination of expectations throughout the network, that's something that it's not really understood. Also, like in the recent inflation surge, your work shows that the frequency of price changes went up like crazy in an unprecedented way from like 0.3 to 0.6. There must be some coordination in the background that is completely new. And that's something that we don't really know what mechanism generated that, so that it would be useful to ask firms why they started increasing prices twice as fast as normal.
Okay. Thanks. I have a question for Damien. Can you explain a little bit more how we should think about the negative net inflation effects?
Yeah. So in this survey, so what exactly do you mean by the negative net inflation effects? Just to make sure that I'm answering the right question.
The part of the distribution that was to the left, that was struck my interest.
Yeah, there are only about 8% of the people who report a negative effect of tariffs on inflation. So I think one could think that it could be that those people think about productivity, that it will be a huge productivity shock, but it also can be that they're so it's difficult to explain those. Just to be honest, how we did that is that we first elicit their inflation expectations, and then we ask them, how much of the tariff effect they embedded in their inflation expectations, right? And in this, that was the hypothetical chart that I showed. And in that sense, there were 8% of people who thought that tariffs will have a negative effect on inflation. So we didn't look too much into those 8% people yet, but I think we can plan. But one potential thing is that they really think it will be a huge productivity shock to the US economy, potentially.
Okay. The next question is for Luca. How do we reconcile this apparent myopia with the fact that firms seem to be very forward-looking in other dimensions? For example, startups have negative profits for years with the promise of higher future returns. Is your idea that firms are attentive along certain dimensions because they have so many things to worry about? I think I was also a little bit surprised by the discount rate that you estimated for the firms because it seems very, very low relative to how forward-looking we normally think of firms.
Mm-hmm. So let me start from, so the model is a Calvo model. The Calvo model is pathologically forward-looking. So this is closely related to the forward guidance puzzle. Like in the Calvo model, because of the way it's set up, firms have basically weight 1 on something that happens in 10 years from now, because the discounting will just be beta is 0.99, and so when you put it to the 10 power, it's a number that is very large. So that is not consistent with the aggregate data that we have on forward guidance. And so compared to that benchmark, I find a very large amount of myopia. Now, the issue is potentially more complicated. So like perhaps Damian knows more about this than me, but my understanding is that when they announced tariffs, at least from the Cavallo evidence, like prices started moving just for the announcement, but very slowly. And what happened is that firms started hoarding inventories. So they have been forward-looking in one dimension, but not in the prices didn't really reflect that. And that might be maybe because of some consumer base that they didn't want to piss off. Like there might be some more complicated story in the background, but I believe that this is true, that there is differences in depending on the decision of the firm. Like perhaps real decisions are different than nominal ones in the way in the forward-lookingness of that in the response to anticipated shocks. Yeah, there is more to study.
Okay. I think we might have time for one more question for Damian. It's routinely reported in the news that imports are subtracted from GDP, which is true in an accounting sense, but a bit misleading. Do we have a sense of what fraction of your respondents have heard this fact and are using this to form their beliefs about tariffs raising GDP?
Yeah, again, so we do ask them, how often they heard news about tariffs as part of the survey. And one thing that we do check is whether the information affected larger or smaller, depending on how many news have you heard about tariffs. And here we get, sort of the standard results that, we can affect the expectations more of those people that they have not heard the news. But we don't have an explicit, question about this particular channel that Rafael is asking for. So about that, the tariffs subtract that imports subtract from the GDP. That is definitely a possibility. I also think that it's possible that some people truly believe that tariffs will raise GDP because they are perhaps they overweight the importance of the manufacturing sector for the US, although it represents a relatively small share in the US economy nowadays. But still, there could be that they're overweighting the effect of potential positive effects on manufacturing sector, and therefore that thing that the GDP, which is something real, and could increase as well.
Thank you. I think that's all the time we have today for the seminar. Thank you to the presenters and the attendees. This seminar will be posted on the Zebra YouTube channel after the fact, and I wish everyone a happy Thursday.
Thank you.
Thank you, everyone.
Buddy.
Bye.